And look, I know exactly what happened at your kitchen table last week. You walked to the mailbox, you grabbed that innocent-looking envelope from your insurance carrier, you opened it, expecting maybe a 5% bump, a polite little inflation adjustment, and instead, you stared at a number that made you think you'd accidentally bought a second house in the Hamptons. 30%, 40%. Maybe a letter that just said, "Dear valued customer, get lost, we're dropping you." And then you did the panic math. You looked at your fixed income, you looked at that premium, and you felt that cold grip in your stomach that says, I'm going to lose this house, not to a fire, but to the bill for the fire. You're not crazy. You're being gaslit by a spreadsheet economy that has decided your safety is no longer profitable. But today, we stop playing the victim. We're going to look at 4 active defense strategies that the insurance cartel praise you never figure out. So we're going to take their rules, we're going to flip them upside down and turn your house into a financial fortress. You ready? Strap in. Let's get right to the first strategy because this is the one that stops the bleeding immediately. And I'm talking about the deductible arbitrage, the war chest. This is the foundational move. You need to stop treating insurance like a maintenance plan, and you need to treat it like a catastrophic shield. Right now, you probably have a $1,000 deductible. That's the trap. Because if you got $2,000 of damage and you file a claim, they might pay it, but next year, they're going to raise your rate by $500 forever. The math, it's insulting. I mean, every time you file a small claim, you are painting a target on your back. You are telling the algorithm, I am needy. And in this economy, being needy gets you evicted from the system. So here's the move. Raise your deductible to say $10,000 or even $25,000 and watch your premium crash. It could drop 40 to 50%. Now, the crucial step here is you do not spend that savings on a boat. You take that monthly savings and put it into a high-yield savings account. We call this your war chest. You are self-insuring the small stuff so you can protect the big stuff. Now, I know what you're thinking. Matt, I don't have $10,000 in a war chest yet. What if a storm hits tomorrow? Fair point. This is where strategy number 2 comes in. Strategy number 2 is the gap hack. Parametric and buybacks. This is how you cheat the system legally. You still raise your main deductible to $10,000 to get the cheap rate, but then you use the savings gap to buy a specific niche product to cover the deductible. And you have 2 options for this. Option A is called deductible buyback insurance. And it's exactly what it sounds like, a cheap policy that only kicks in to pay your deductible. Option B is the future. It's called parametric insurance. This is Moneyball for your house. It doesn't pay based on damage, it pays based on data. So if a wind sensor in your zip code hits 90 miles per hour, boom, they wire you 10 grand. If the ground shakes at a 6.0 magnitude, boom, they wire you cash. No claims adjusters, no arguing about wind-driven rain, just a robot sending you a check to cover your deductible. It's cleaner, it's safer, and it lets you carry that massive deductible without the fear. And look, before we get to the next strategy, you need to understand why this works. You need to understand the game that you're playing. You see, the insurance industry is a casino that realized the slot machines were paying out too often. So they decided to just bolt the doors shut and keep your cover charge. So this isn't just inflation. They call it risk mitigation. I call it subscription serfdom. Because right now, if you have a mortgage, you are mandated to pay this bill. You've got to. You've got a gun to your head. The bank says, pay the insurance or we call the loan. Then the insurance guy says, pay the premium or we cancel the policy. And you are stuck in the middle, squeezed like a tube of toothpaste in a hydraulic press. The system is designed for passive consumers. It is designed for people who auto-pay, who don't read the fine print, and who treat insurance like a maintenance plan. If you play that game, you lose. The house always wins. But if you stop being a consumer and start acting like a risk manager yourself, suddenly you've got options. Options like strategy number 3, the unbundling maneuver. This is for those of you in Florida, California, Texas, the danger zones. You see, for 30 years, they trained us like Pavlov's dogs. Bundle your home and auto and save 15%. And it sounds great until you realize the bundle is a pair of handcuffs. You see, when you bundle, you put your entire financial life in the hands of one company. So if State Farm decides they don't like your roof, they threaten to drop your car too. They hold your mobility hostage to secure your home. So we want to decentralize the risk. You fire the big giant carrier. You go out and buy a bare bones policy, often called a fair plan or a fire policy. And it covers only the structure burning down, nothing else. Then you buy a difference in conditions policy, a DIC, basically a wraparound policy. And this covers the theft, the liability, the water damage. And why do this? Because it breaks the monopoly. If the fire policy cancels you, you still have the wraparound. Don't let one CEO in Illinois control your entire safety net. We are seeing reports of carriers using drones and satellite imagery to zoom in on your roof. If they see a patch of moss the size of a dinner plate, canceled. If they see a trampoline in the backyard, canceled. They are looking for any excuse to dump you because their algorithms say you aren't profitable enough. So you need to make yourself impossible to kill. And that brings us to the nuclear option, strategy number 4. And this is for the brave. This is for the people who are truly done. You see, if your house is paid off, you do not have to have insurance. And I know it sounds insane, but think about it. If your premium is $10,000 a year, and over 20 years you give them $200,000, that is half the value of the house. The nuclear option is this. You fire them all. You take that $10,000 a year and you buy gold. You buy treasury bills. You become your own central bank. Yes, if the house burns down, you're in trouble. But remember, fire usually doesn't destroy the land, and the land is often 40 to 60% of the value depending on where you live. And I'm not telling you to do this lightly, but I'm telling you that you have the right to do this. But listen, because this is where most people get wiped out. Fixing your insurance is a massive win. It stops the bleeding on one specific wound. But if you stop there, you are just patching a hole in the hull while the government is drilling 3 new ones on the other side of the boat. You cannot just be a resident anymore. You have to be the CEO of your house, Inc. And a CEO doesn't guess where the risks are. A CEO audits the books. You need to know exactly where your equity is exposed, whether it's a tax assessment that's too high, a legal privacy gap that's too wide, or a probate trap you don't even know existed. You need a diagnostic check for your entire financial life. And I walk you through exactly how to run that stress test and how to find your personal household defense score in this video right here. We're going to look at the leaks you don't even see yet because the system is banking on you being disorganized. They are counting on you missing the details so they can siphon off your wealth while you're distracted. We're going to tighten up the ship and turn your home into a fortress. So let's get that audit done.